If you pull your expenses out of 2023 and into 2022, you are shooting yourself in the foot because you are taking deductions against a higher income and a higher tax bracket and pulling them into a year where you're in a lower tax bracket and you're already paying less taxes. Welcome to Profit and Prosper, a podcast for entrepreneurs who are ready to make some money while doing what they love. On this podcast, we're going to pull back the curtain and talk about all things business and money, but I promise you this is not your typical boring numbers talk. I'm your host, Sarah Young, a CPA and CFO with over a decade of experience in finance, business, and leadership. I'm going to share everything I've learned from helping my clients grow more profitable businesses and keep more of what they earn while growing my own successful business along the way. You'll feel empowered and confident that you too can grow your wealth, live a rich life, and have an impact. Stick with me and you might even start to think that finance is fun. Let's dive in. What's up, y'all, and welcome back to this week's episode. So it's now the middle of December, which is sort of crazy. The year is almost over. By the time the holidays are done, it's all going to go by just in a flash. So we all know there's a lot of stuff that has to go on with finances and taxes around the end of the year. And so in this episode, I'm going to give you 11 things that you need to take care of as a business owner around the end of the year. Including number 9 is something I have seen popping up a lot lately on social media, and that is this question of, should you pull expenses into 2022? Should you, buy a bunch of things in order to save on taxes? I'm going to give you my thoughts about that one. Before I jump into the 11 things that you need to do, I do want to tell you that the next 3 weeks, we are doing a roundup of the top 3 episodes of 2022. So I started this podcast back in February. We have almost a full year of episodes, if you can believe it. And so this will be a roundup of the 3 most downloaded episodes of the year. And this will be really great for those of you, I know we've had a lot of new listeners come in over the last couple months. And so this will be great for those of you who need to catch up and you want to see our greatest hits of 2022. So I am excited for that. And we will be back in January with new content. I have a lot of things I want to talk about. I have a lot of things on the docket for 2023. Lots of good guest interviews already scheduled. So I'm really pumped for all of that. So with that said, let's dive into 11 financial tips and things that you need to put on your to-do list as a business owner as you wrap up the year of 2022. Item number 1 on the list is you need to get your books updated. That means you need to get your transactions done. If you have not done this in several months, or I know some of you haven't touched it in, the entire year, now is the time to do that. And now is also the time if you know that you need help from a bookkeeper to get your financials done, do not wait. A few reasons to not wait to, get your books done. Number 1, the longer you wait to get it cleaned up, the more that you're going to forget about what happened in 2022. It becomes easier to forget, those transactions that you maybe paid on your personal credit card, or maybe you forget what, this particular expense was for. It just gets more and more difficult the farther out you get from the year. When it comes to hiring a bookkeeper, this is something I believe people should not be, super cheap about. I think that bookkeeping for 90% of you is just not something you need to spend a ton of time on. And so, just realize that from now until March, April is a really busy time for bookkeepers, especially the good ones. So if it's something that you want to do, if you've been thinking about it, go ahead, hire the bookkeeper, reach out, get some support. You will thank yourself later. Not waiting until April 14th to get it all cleaned up. Number 2, along the same vein, is tax help. So you know that if you have an S Corp or a partnership, your tax returns are due for the business on March 15th. And then personal returns, including if you're a Schedule C filer, those are due in April. I think it's actually April 17th or 18th because the 15th is on a weekend or holiday. Either way, the standard deadlines. So now is the time, if you need somebody to file your taxes for you, you need to reach out to them now if you haven't done so already, because again, the good ones are probably already almost full. I would say, for us, for example, we stopped taking on new 2022 tax clients a few weeks ago, actually probably a month ago. And we will take new clients on in early 2022, but we will not really start doing anything. We will file extensions and we won't start doing any returns or anything until after the April 15th deadline and after my team has a little bit of a breather. So just know that. And so if you want to get somebody to help you do your tax return, do that now. Reach out now. Don't wait any longer. And the second part of tip number 2 is make estimated tax payments. So the last estimated tax payment deadline of 2022 is on January 15th, 2023. If you have not made any estimated tax payments for the year, then I would say, after you get your books updated, that was tip number 1, look at your profit for the year. At least say, 20-25% of that profit, you need to be planning for how am I going to get the cash to make that in a tax payment. And go ahead and plan to make that in January. You will definitely want to have that paid by April, but the sooner the better generally. For purposes of this episode, I will not go into safe harbor payments because I think that's sort of confusing to talk about on a podcast, but this would be an option for you if your income is increasing drastically year over year. At least by January 15th, you want to have paid in about, the taxes that you owed from 2021. So if you want to look into the safe harbor payment more, just go Google how does safe harbor payment works and see if that might apply to your situation. But either way, y'all, please don't wait until Q1 to realize oh crap, I've got thousands of dollars, sometimes tens of thousands of dollars that you're going to have to pay in taxes and you don't have that money set aside. So make a plan for that ASAP. Tip number 3 is around mileage and your car. So if you drive for work, at least some of the time, it is a really great habit to record your mileage around the end of the year. So literally, take your phone out to your car as close to December 31st as possible. Take a picture of your mileage and then set a reminder to do that on next December 31st as well, so you can see how many miles did you drive. And that makes your life easier when you have to go through and say, maybe if you drove your car for business 20% of the time, and the 20% because you took a picture of the mileage, then you can take 20% of your auto expense for the year and write that off. For me, I actually don't drive my car a ton for work, at least not currently. Starting to drive it a little bit more with things opening up after COVID. I'm going to more events and things. But what I do is, I just have a Google sheet and I will literally a couple times a year go through my calendar and I will see the events that I had on my calendar and say, oh, I had to drive to that. And then on the Google sheet, I will put the date where I drove to, how many miles it was. I just calculate it on Google Maps and what the business purpose was, just a little note about that so I can remember. And then I use that for mileage on my tax return. But y'all, mileage can easily be, for some of you, $1,000 or more in a tax deduction, which is a couple $100 in tax savings. And if you drive a lot for work, then it's definitely going to probably be more than that. So tip number 3, record your mileage on or before December 31st.
Are you ready to change your money story this year and feel confident about your next moves to create more profit and cash flow in your business? You've probably already thought about your business goals for the upcoming year, but I don't want you to forget the financial side of things. How can you make sure that you are taking action on the areas where you'll see the most immediate, biggest impact on your bottom line? Because having a wealth-generating, profitable, and resilient business doesn't happen by accident. You need to take intentional steps toward creating more profit. That's why I created my totally free financial review workbook. In it, I will walk you through how to assess your business's financial picture with no math required, how to think big picture about what worked and what didn't with your finances in the last year, and how to identify your next 3 money moves to make in the upcoming year. To get your free workbook, visit the link in the show notes or go to trustyoungco.com/review and be on your way to a more profitable and aligned business.
Number 4, Also, as close to December 31st as you can, if you have inventory, you need to do a count of your inventory. So if you have an e-commerce business, a retail store, if you have inventory on hand, I'm not talking about job supplies like, trash bags and tape or whatever. I'm talking about inventory that you sell. It is a best practice to get an inventory count, like I have 5 of this SKU, I have 10 of this SKU, and get that documented. Whether you're tracking it in a spreadsheet or hopefully you're tracking it in a software, do a count and then compare that to your records. And the reason for this, as much of a pain as it might be, it's just one, super important for you to keep track of your inventory. But we would also use that information on your tax return. And so we need a good count of how much inventory you had on hand as of the end of the year. So make sure you take time, again, as close to December 31st as possible to do that inventory count. Tip number 5 is if you have been eyeballing new systems, especially any sort of accounting or financial systems, January 1st is a great date to make that switch. So if you've wanted to set up QuickBooks for a while or any other accounting system, it is a great practice to get that set up and ready to go as of January 1st. So like I would open the account and work on getting things connected close to January 1st. If you want to switch payroll providers, for example, we have clients who are just coming on board, and we generally at the end of the year keep their payroll provider, but then switch them over to something like Gusto. That's my favorite payroll processor for all of their January payrolls. And so we're getting that set up right now. We're getting these things, getting their employees onboarded. Same thing with, billing systems, payment processing. It's just nice and clean to switch those over around January 1st. So if you have been eyeballing new accounting systems, it is a great time of year to do that. Tip number 6, this one goes out to you S Corp owners. So if you have an S Corp, you need to make sure that you run payroll for yourself for your reasonable salary if you have not done so during the year. So during December, for all of our clients who are S Corps, which is most of them, if not all of them, but probably 80 to 90% of our clients have S Corps, we will go through and make sure, did they run payroll for themselves throughout the year? Do we need to do a catch up? Is their salary what I would call reasonable for the work that they're doing? We just need to make sure that's cleaned up in December, because if you wait until after December to run payroll for yourself, you run the risk of not being able to get that salary filed as part of your 2022 payroll tax returns. And you might also have to amend the payroll tax returns, which is not the end of the world, but it's sort of a pain in the butt. And so if we can just avoid that by getting your payroll caught up in December, everything's going to be a lot easier. Keep in mind, you need to have what's called a reasonable salary. And again, outside the scope of this episode to go way in the weeds of that. But what I would say in terms of a reasonable salary is looking at it, from what is the work you're doing? What would you have to pay somebody else to do for you? But I also generally don't like to see your salary be more than your profit. So if your profit is $50,000 in total for the year and you pay yourself $75,000, that puts you in a loss position of $25K, because you're going to subtract that 75. And so on your personal return, you will have W-2 income of $75,000 and then a loss from your business of $25,000. Number one, that results in basis issues for S Corps. But I also could make the argument potentially, is it reasonable that a business who doesn't have, $75K in cash flow is going to go hire anybody for $75K? No, you're going to hire somebody part-time on a fractional basis, potentially, to do the work that needs to be done within the limits of your cash flow. So make sure you get your payroll all caught up and run in December if you need to. Tip number 7 is it is a really great time to go ahead and sit down and make a plan for 2023. I talked about this back in episode 43. I have a whole year-end review workbook that goes along with that episode. So I would go listen to that. When you're having some downtime, some quiet time, I find for me, those are the best times to come up with new ideas and to do planning and goal setting. So it's just a really great time to do that before you get into the hustle and bustle of a new year. So I would highly recommend go listen to episode 43 and grab the workbook that goes along with it to do some goal setting and identifying what it is that will help you increase your profitability in the new year. What are the things that you need to do, the money moves that you need to make in the new year? You can get that workbook at trustyoungco.com/review. Tip number 8 is your retirement accounts. So if you are going to contribute to your retirement account, the deadlines are all either around December 31st or your tax return due date. And so if you are going to contribute to your retirement account, if this is part of your tax plan or tax strategy, you need to make sure you do that on time. So if you have, for example, a regular old employee 401k, you would need to make the employee portion of that contribution before December 31st. So the cash needs to leave your account by the end of the year for that to count for 2022. If you have a solo 401k, then you need to have that plan set up and in place before December 31st. As the employer and the employee, because you run the business and you also work in the business, you have to make the employee contributions also by December 31st, but employer contributions can happen by the business's income tax return due date, including if you extend it. If you have a traditional or Roth IRA, those just need to be made by April 15th in order to count for 2022. And then if you have a SEP IRA, that one needs to be, you need to make those contributions by the business income tax return due date. So March 15th, or if you extend it, September 15th. One quick caveat about, taxes and should you make a traditional contribution or a Roth contribution? And I'll tell you what I tell my tax clients. If you are actually, let me back up. A traditional contribution is you get a tax deduction in this year for the money that you put in. So if you put $6,000 into a traditional IRA, assuming you are within the income limits, you get a $6,000 deduction on your tax return, which would save you, $1,500, $2,000-ish in taxes, depending on your bracket. When you take the money out years and years down the road, that money has grown because you invest it, hopefully, in things that give you a good return. That money has grown. Every dollar you take out, including what you contributed and the earnings, those get taxed at whatever tax rate you have in effect at the time when you take the money out later. The other option is a Roth IRA. And so for a Roth, you do not get any deduction in the year that you make the contribution, but the money, again, grows over time. When you take the money out of your Roth, it is all tax-free. So you don't pay tax on it down the road, including the earnings. So I think Roth contributions are amazing. And I think people don't take advantage of them enough because we like to get the tax deductions now. So what I suggest to my clients is if you are in one of the lower tax brackets, certainly if you are in the 10 or 12% tax bracket, you can go look up just Google your tax brackets and you should be able to estimate based on the income that you have for the year. If you're in one of the lower tax brackets, one definitely make the Roth contribution because the tax rate, yes, you will pay taxes now, but it's so much lower than, being in the 20s or 30s in terms of that tax bracket. I still like to have my clients who are in the 22 or 24% bracket, generally speaking, make a Roth if possible, unless they're in a very high state, in a state with very high income taxes. So that, if they're in the 24% bracket for federal and like 10% for state, that would put us at 34% overall. Like that's pretty high. So we may balance between the two, between Roth and traditional. If you are in one of the higher tax brackets, so if you combine yours and if you're married, if you have a spouse, combine your income together. If you are in, certainly the highest brackets, 37, 32, 35, or 37 brackets, generally speaking, we might look at taking a tax deduction out, at least some, because when you combine that high tax bracket with the state income tax, it can be a lot. So just make sure that you contribute to your retirement accounts by the due dates, whether that is in December or sometime in Q1. Tip number 9 is this question of should you pull expenses into December because you'll get a tax break for them? So I have been seeing this a lot on Instagram, and I always think it's interesting when it's people who are also trying to sell you something, like they're running a launch or a promotion of some kind, and they are arguing that if you invest in that thing, then you'll get a tax break for it. While it's true that buying something for your business will give you a deduction, It is not always a best practice to just by default buy everything that you possibly can in December. So I'm going to give you a couple examples of when I think this works really well, just so you can kind of see. So basically, the argument is, if you pull expenses into Q4, things that you would have bought in 2023, if you can pull those expenses and actually pay cash for them in Q4, then you get the deduction in 2022. Then you save money on taxes, which directly reduces the cash that you're going to have to turn around and pay for tax. So, for example, if you buy something that costs $1,000, let's say your overall tax rate is your overall tax rate is 25%. That means your taxes on that $1,000 that you would save would be about $250. So you have to pay the $1,000 to save $250. That's how tax deductions work, right? You're going to get that deduction whether you buy it in Q4 or Q1, right? So you want to time it if your income is going to drastically change year over year. Let's say in 2022, you had a high-paying corporate job and you side hustled, and you were going to quit in 2023, early in the year especially, and go full-time with your business. It is highly likely, if you had enough income from your job to push you from the 24% bracket into the 32% bracket, especially. For reference, that threshold is $170,000 if you're single, $340,000 if you're married. If you got up into the 32% bracket because of that, next year you're going to quit your job, you're not going to have that high income, and you're going to go full-time in your business. It is highly likely you will not make nearly that much money next year as you did this year. And so if you can pull expenses into 2022, then you can get yourself down. You're going to save 32% if you're in that higher tax bracket, versus comparing it to 2023. If your income is lower and your taxes are lower, then the benefit is going to be a lot less, right? So there's an argument for if you need to reduce your income in 2022 and you think it's going to be lower already in 2023, then it's a good idea to pull it forward. Let's say on the other hand, your business is growing like crazy and you're going to profit maybe $100,000 in 2022, and you forecast that you're going to profit closer to $300,000 in 2023. That is going to push you very likely up into the 32% tax bracket in 2023, depending on other factors, right? So just roll with it. Assume you're in a higher tax bracket. If you pull your expenses out of 2023 and into 2022, you are shooting yourself in the foot, because you are taking deductions against a higher income in a higher tax bracket and pulling them into a year where you're in a lower tax bracket and you're already paying less taxes. So if you think your income is going to increase drastically, then I would say you need to be pushing expenses as much as possible into Q1. And so this is why, just be aware of taking tax advice from people on the internet, especially if they're not actual tax experts, because there's always nuances around whether or not this is a good idea. And I think even worse, if you don't have a lot of income in your business already, then, if you don't have a ton of taxes, then I would say, pulling your expenses into this year is not going to benefit you that much. Okay, so number 9, there's my thoughts on timing of your cash to save on taxes. My last 2 tips are things that would need to happen in Q1, but I wanted to go ahead and put them in here as reminders just to plant the seed. So tip number 10 is in January, you need to make sure that you file all of your tax reporting forms for contractors and employees for 2022. For contractors, you would need to file 1099s if they performed a service for your business, if you paid them more than $600 in the entire year, and if you did not pay them via a payment processor. Like if they sent you an invoice via Stripe, then they're already getting a 1099 from Stripe. You don't need to double count that 1099. You can still send one if you really want to, but you don't have to. This would be applicable if you pay them with check, if you sent, Venmo personal transactions to them, PayPal personal, not PayPal for business. If you paid them in cash, Zelle, things like that, or just an ACH transfer from your bank. You need to file 1099s. So go ahead right now. If you do not have W-9s, request them from your contractors. Just go on and Google W-9 and you'll probably see the very top link is from the IRS webpage. It's just a PDF that asks them for their name, tax ID, address, legal entity status, and for them to sign it. It's very straightforward. Okay, so go ahead and get those on file now to do yourself a favor, because you will use that information to file 1099s in January. You also need to make sure that you get all of your employee payroll forms filed. If you're using a payroll processor, this will do it for you, but just make sure, go into your payroll processor and make sure there's nothing that you need to do. Sometimes they have a checklist of things you need to confirm for them to file your W-2s, file your final 941s and 940s and your state forms. Just go ahead and do that, before the end of December, so you can make sure everything gets done on time in January. And then tip number 11 is, if you are thinking about becoming an S Corp in 2023, you need to elect S Corp status before March 15th of 2023, assuming you have a standard, January 1 to December 31st tax year. So people ask me, should I just be an S Corp as soon as I start my business? My answer is pretty much no, because I find that if you don't make a lot of profit in your business, you actually can end up paying more in taxes by being an S Corp, because you lose out on things like the qualified business income deduction, for one. And so my threshold is usually, if you're projecting around $75,000 in profit, so sales minus business expenses is your taxable income. When you hit that $75,000 mark, that's usually when it is beneficial for you to make that S Corp election. So if you want to elect that, remember, it doesn't change your legal entity status. It is just a check the box tax form. You have to get a form 2553 and get that filled out, signed, and sent. I would probably have an accountant do this for you, because if you don't do it right, when it's easy to miss one of the boxes, they'll reject you and send it back and say, try again. So I probably get help there. So that is all I've got. These are my top 11 sort of tactical year-end financial things that you need to take care of as a business owner. So, go through this list, figure out what things you need to put on your to-do list, schedule some time to do it. Just stay on top of things, y'all. Stay organized. You will thank yourself later when your whole tax season is just a bajillion times easier and smoother. So that's all I've got. Next week, we will be here with our number 3 episode of 2022. And like I said, I'll be back in the new year with brand new weekly content and podcast episodes. So I hope everybody has happy holidays, a happy new year, and I will see you next time.
Thanks for listening to this week's episode. Now, I want you to go take some action. What's one thing you can do this week to create more profit in your business? Send me a DM on Instagram at YoungCoCFO and share your action item with me. If you have a question or topic you'd like me to dive into, or if you're feeling empowered about taking charge of your finances, let's continue the conversation. Go to profitandprosper.co to submit a question or topic for me to talk about on the show. And because we all profit and prosper better with friends, please leave me a review on Apple Podcasts, subscribe wherever you listen, and share the episode. Make sure you tag me at YoungCoCFO on Instagram so I can give you some love, and I'll see you in the next episode.